The Dow, as I said, on pace for its best October ever, the best overall month since 1976. But will the recent market strength carry over into the final 2 months of the year? Let's bring in Samana from Wells Fargo Investment Institute on one side of this debate and Jim Paulsen from Leuthold Group on the other. So, Samir, the question is, did October kill the bear market? What do you think?
No, we don't think so. We think the trend is still lower. We think valuations are at best fair. And we think the market could easily chop sideways into year end, but probably does have a little bit more of downside risk than upside risk.
Why?
So, again, I come back to the Fed's still raising interest rates. Now, if they go from 75 to 50, that doesn't change what they're doing, right? They're still tightening policy. A lot of people also are confusing the rate side for the balance sheet side because quantitative tightening goes in the background. So if the Fed does nothing, you continue to have that balance sheet unwind. And all the work that we've seen basically suggests that it wasn't those zero rates that led to overvalued markets. A lot of it had to do with the Fed expanding their balance sheet at a very fast clip. So if now that's working in reverse, clearly it's going to have a negative impact.
It really doesn't get as much airtime, the whole balance sheet tightening thing. So, Jim, you disagree. You've been positive for a long time, and you're staying so into year end and into next year?
I am, Sarah. You know, I think I look at the trailing P multiple in the S&P 500 now lower than 70% of the time since 1990. I look at sentiment that's very washed out. I think nervous Nellies have had ample opportunity to sell various times this year. The sellers that are Yancey are probably gone. And I think the Fed policy is clearly unsustainable. We're seeing cracks all over the place, and certainly declines in inflation, but also now in real economic growth and other illiquidity problems emerging. Also, you know, Sarah, what I've found when I look back to the 1980s is that the 10-year yield has led the Fed on every tightening cycle. And it peaks out before the Fed's done. And oftentimes the Fed keeps tightening, but the 10-year yield stops rising. And the stock market doesn't wait for the Fed to get done. It generally responds when the bond market is done. So I think the bond market is close to blinking. And even if the Fed continues, I think the stocks might already be responding to that.
I don't know, Jim. The 2 years back to 450 today.
Well, yeah, but I'm talking about the 10-year yield that tends to lead the Fed. And the 10-year yield was, you know, rose at 4.33, you know, intraday. It might go up a little more, maybe 4.25. It's peaked out. But I'm saying if it's going to stop there, and at some point, Sarah, I think it will, the Fed might continue to lift rates. You know, in lifting the rates, what the Fed is doing is lowering inflation fear and raising recession fear. And if inflation fear is the dominant force, we have more bond sellers than buyers. But if recession fear rises, we'll get more bond buyers than sellers. And I think we're getting close to that.
Samir, what's your take? You don't think the Fed is going to switch policy paths anytime soon?
It just seems premature. And, you know, when you look at long rates and you look at their historical relationship to whether it's GDP or inflation, I mean, history tells you that, you know, much higher rates are warranted, especially if you're trying to bring inflation down, right? I mean, you know, just to get real rates, you know, north of, you know, into positive territory, shoot, right now you'd have to raise them into kind of the 7 to 8% range. Again, that's not the case, but I don't think it's hard to see, you know, the 10-year going, you know, pushing up to 4.5% to 5%. Especially if that's where the short end of the curve is going. So, and from that standpoint, the equity risk premium, especially based on kind of where we see earnings going, which is our number for next year is 200. So you're actually going to see negative growth in 2023. You're just not getting paid to take the risk. It's not so much that we don't see better days ahead. Our target for next year is actually 4,400, but it wouldn't surprise me if much of those gains come in the second half of 2023 after things start to fall into place.